Have you ever thought about investing but felt completely overwhelmed by where to start? Maybe you've got some savings set aside, $5,000, $10,000, or even $25,000, but you're not sure what to do with it. Should you put it in stocks, real estate, crypto, leave it in the bank? Let me tell you something that most people don't realize. You don't need to be rich, a stock market genius, or lucky to build serious long-term wealth. What you do need is a clear plan, patience, and a strategy that works while you sleep. And that's exactly what we're diving into today. In this video, I'm going to walk you through a powerful step-by-step strategy to build a monster dividend portfolio. A portfolio designed to grow your money, pay you consistently, and stand the test of time. A portfolio that can take $25,000 and turn it into over $2.5 million, all while generating over $70,000 in annual dividend income. Sounds like a fantasy? It's not. It's simple math, time, and the magic of compound growth with dividend reinvesting. But first, let's zoom out for a second. Why you need an income-producing portfolio? When people think of wealth, they often think of net worth. But what really matters is cash flow. How much money is coming in each month without you having to work for it? Inflation is eating away at your money every single year. What $10,000 buys today might only buy $6,000 worth of stuff in 10-15 years. So if your money isn't growing, it's shrinking. That's why saving alone is not enough. You need to own assets that grow and pay you consistently. Dividend stocks are perfect for this. They're real companies with real profits that pay shareholders a portion of their earnings, usually every quarter. Over time, these payments add up. And if you reinvest those dividends to buy more shares, you trigger the most powerful force in finance, compound growth. Now let's build that portfolio. Step 1. How many stocks should you own? Diversification is your shield. Putting all your money in one company is risky, even if that company seems unstoppable. Companies rise and fall, industries shift, disruption happens. So we aim to own around 17 to 25 stocks across different sectors. Why 17? Because based on data, that's a sweet spot. You're diversified enough to lower risk, but not so spread out that you can't manage or understand what you own. This also protects you from company-specific risk. If one of your stocks drops 30%, you're still fine because it's only a small slice of the pie. Step 2. Equal weight. Your positions. Let's say you're starting with $25,000. Instead of putting $10,000 in one stock and $500 in another, we simply divide the investment equally across all stocks. That means about $1,470 in each stock if you're buying 17. Why? Because we can't predict which stock will be the best performer. By equal weighting, we give each one an equal shot at driving returns. And we reduce emotional bias, like doubling down on a favorite company or neglecting a sleeper hit. This system builds balance into your portfolio from day one. Step 3. Stay sector smart. Next, we protect the portfolio by not going too heavy into any one sector. The rule of thumb? No more than 25% in any single sector. For example, you might love tech, but tech crashes hard during downturns. Energy can be super profitable, but also highly volatile. Real estate is stable until interest rates spike. So what do? We spread across sectors like tech, healthcare, finance, utilities, consumer goods, industrial, real estate, and energy. That way, when one sector slows down, others can carry the weight. This built-in safety net allows you to sleep better at night and let your investments grow without constantly stressing over the news. The real numbers, how it grows. Let's say you invest $25,000 into this monster dividend portfolio. 17 top-tier dividend stocks, spread across sectors, equal weighted. With an average dividend yield of 2.47%, a dividend growth rate of 14.41%, and an average price growth of 15.21%, here's what happens when you reinvest all dividends and let it compound. Year 1. $25,000 grows to around $29,500. Year 10. Your portfolio crosses $113,000. Year 20. It explodes to $528,000. Year 30. You're sitting on $253 million. And the best part? You're now making around $6,000 a month, just in dividend payments. That's $72,000 per year, fully passive. You didn't need to pick the next Tesla. You didn't need to day trade. You didn't need to time the market. You just followed the system and gave it time. What kind of stocks are in this portfolio? Some examples include Viper Energy Partners, massive yield E+ energy exposure. Microsoft, tech giant with growing dividends. Progressive Corp, solid performance in finance insurance. Equity Lifestyle Properties. RAT with dependable rental income. Old Republic, Lind, United Parcel Service, and many more. These are real revenue-generating companies, not hype stocks. Their track record shows steady income and reliable growth, with increasing dividends year after year. Final thoughts. This strategy works if you let it. The truth is, most people lose money in the stock market because they're trying to get rich fast. They chase hot tips, panic during dips, and constantly jump from one strategy to another. But wealth isn't built by flipping trades. It's built by owning great assets for long periods of time. That's what this monster dividend portfolio is all about. If you're serious about building long-term wealth, retiring early, or simply creating passive income, this is your blueprint. Whether you're starting with $5,000, $25,000, or more, the key is to get started, stay consistent, and let compounding do its work. Because 10 years from now, you'll be glad you did.